everyone. A very good morning, good afternoon, and good evening to all. Myself Vaibhav. In today's session of automated trading, we will be continuing to work with the Williams R and the historical candle. This is our first session after the long Easter weekend, so I hope all of you are feeling pretty fresh and raring to go. This is a functionality of the Williams R, and it's a pretty simple indicator used to determine the overbought and oversold condition. And if not for this upside down scale, it is almost kind of similar to the stochastic, but to some extent, I think it is better, but it depends on your preference. Then the ATR we will use to define the volatility for the underlying instrument. Before we go into the details, there is a standard disclaimer. Here I would like to remind you that this is simply a tutorial session where we will be trying to build an efficient enough to trade in the financial markets, and no claim is being made regarding the profitability or otherwise of the algorithm which we will be developing during the session. Suppose if any of you wants to use any of the algorithm, I would suggest that you do extensive trial runs, maybe for many months and even years, and then let it run for sufficient enough time on the demo accounts to get a clear idea of the efficiency. And nothing in the webinar is to be constructed as an advice to trade or for any particular setup. Now let's go back to the chart. In Thursday's session we had done the first part, and there we had looked on the idea. So what we are trying to achieve is pretty much simple. We are trying to make sure that if we are looking for a buy trade, then that instrument should have been in the oversold territory for quite a amount of time, at least a day, and just inverse for a sell trade, we will be looking for the condition that it should have been in a overbought condition for at least a day, and then even after that there should be extended run after being in overbought condition or oversold condition in case of buy, and that run should be more than 100% of the ATR, that is the average true range, and that run should have happened immediately preceding to our order execution time. And for that we are bringing in some conditions using the historical candles and Williams R indicators. So let's take a look on what we have done so far. This is the standard instrument subscription. We are using Euro USD, and then the position amount has been defined at 0. Williams R, shift 1 and the shift 6. We will be taking the values to determine the overbought or sold conditions, and then our desired price action, which will be defined using these historical candle blocks. We are using 5 blocks with shift 1, 2, 3, 4, 5 respectively, and then comes the ATR, and then we are also calculating the difference between the last candle close and the candle with shift 5, so that in the preceding hours the movement, as I said, more than ATR, 100% of the ATR should have happened. So for that we are defining these two conditions differently for the sell trade and differently for the buy trade. Now on this setup we are going to further build during the session. We will first look for working with the buy side and then the sell side. Let us go back on chart again to see what kind of conditions we need for a buy trade. So whenever we are looking for a buy trade, we want immediate 4 preceding candles, not immediate 4, one after the immediate one, because we will need the shift 1 candle to have closed in green, and the 4 candles prior to that candle should have closed in red. So let me show you some example where that condition might have been fulfilled. So like this, somewhere here that condition would have been fulfilled, as we have this Williams R has been in oversold territory And if we take the shift 1 value and then shift 5 value or shift 6 value, what we are using, let me go to the visual GeForce setup. So here we are using shift 5 and that no, we are using shift 6 on the Williams R. So we will be comparing these values, and now let us go back on chart. So see here, if we had checked the shift 1's value and then the shift 6 value of the Williams R, it would be below minus 70, which is our defining factor, and then the last candle has closed in green. So here during this candle our new trading conditions would be fulfilled, and if we have defined any algorithm, that algorithm would have executed some trades and we would have made decent amount of money. So that's the idea behind our algorithm, that even after being in oversold condition again, it should have continued to fall, and that fall should be more than the ATR range. So it will mean that it has really overstretched, and now if it is showing some signs of reversal, we will be ready to pounce on that opportunity. So we get to the work now. We will need a lot of if conditions. We have to check for all the candle opens and the candle close, all 5 historical candles. So let's take 5 blocks first, and the multiple action also is going to be required. We bring in the multiple action as well. It is in logical. Okay, we got it. As is the case, we will leave one line, one space enough that it should be able to accommodate one line of the indicators if the need arises. So we have done that, and now let us start checking on the historical candles. So when we are looking for a buy trade, we want the prior candle to have closed in green, the last candle, the candle with the shift 1 value. So we go here, take the auto created variables, we look for candle 17, and here we got the candle open and the candle close. Now when it has closed with gains, that will mean that candle open is less than the candle close. So we will define that condition. Candle open should have been less than the candle close. Now we look for the candle 18, and here the candle open should be greater than the candle close. So we take the candle open and the candle close, as it had closed with decline, so it closed lower than the opening price. That will mean that opening price was greater than the closing price. Same thing. Oops, I have done a mistake here. I overlooked that we took the values from candle 17 again, so pardon me for that. And we go here, candle 18 we need. Let me be sure. Yes, candle 18. So we now take the candle 18's values. Candle open and the candle close, and it should have closed lower than the opening price, so we are right. Now it's time to check on the candle 19, the candle with the shift 3. So let us not make the mistake again. Okay, we got it. Now here we have to do this way for all the 5 candles. So we will try to be pretty swift. Candle open should have been greater than the candle close. So here we are. Now, yes, candle open is greater than. Now is the turn of candle 20. And we take the candle 20 is open and the candle 20 is closed, and it should have been greater. So we again connect the dot. This candle open is greater than the candle closed. Now last candle is remaining, so we go there and check. It is candle 21. Let me be sure that we are doing it right. Yes, and it's the turn of candle 21. Candle open and the candle close. So we are pretty much done with the checking of the values. Now we need to take 2 more if blocks for the requirements of the Williams R. So here we got the 2 more if blocks, and the candle open should have been greater than the candle open. The candle close. Let's take this block where they belong. Okay, let us arrange this and then we will so the candle 17 is here. Candle 17 is the first. So we connect it. Then comes the candle 18 and the 19. And the 19. Then comes the 20. 20 is here. Then comes the 21. Okay. So now we go looking for the Williams R values. Here we will check on the shift 6 value first, only if it has been in a oversold territory a day back as well. Only then we will proceed with the trade execution. So we want the Williams R value to have been less than the -30. I will explain to you on chart. This is the 4-hourly chart, and here it should be less than -70. Suppose if it is higher, then no trading will happen. So that is the condition which we are working with. -52, -93, and we need -70. -70. So it looks good, and it should have been less. So here we are, and and we also want the Williams R15's value to be less than the minus 70 as well. So here we take and we do the same thing, minus 70. So it has been in a oversold condition for quite a long time now, at least today. Now we also have to ensure that the difference, that is the movement price action, which has resulted in the price difference, is more than the ATR for the candles which have closed in red, that is the point from where the sell off started to the point where the sell off subsided, from where the buying came in. That difference should be more than the average true range of the day, and we are taking yesterday's value for the ATR. We take the if condition now, and Williams R should have been less than the minus 70. It's alright. Now we got the task of comparing the candle open 21 candle 21's open price and the candle 18's closing price. So here it should have been more than the ATR. So we take this, and now so far so good. So we are almost done with the basic requirements, but the question arises, where exactly are we going to look for the fresh entry? Now we need to go back on chart and see what can be the optimum condition, what can be the optimum combination which we can utilize for determining the entry and the exit points. So let us go back on the chart, and the same example here as we did while I think we can do one thing, and that one thing is whenever the candle close, the prior candle's closing price, whatever is the price, we can say deduct 10% of the ATR, or you can even define fixed pips, and then we can take in some historical candles of 10 seconds, and we can go for a market open. So whenever price goes to that level and starts to rise, a new trade will happen, and on the lower side we can fixed in some stop loss as well. So that is the one way to go about it, and I think it should work fine. But suppose if it doesn't, then we don't have much choice. We will simply stick with our basic parameters. If the trade works out well, then well and good, and if it doesn't, then the stop loss should be there and our losses will be pretty much minimum. So that's what we can do here. Here also you will see that our selling condition would have been fulfilled, as we have these 4 consecutive candles closing in buy, and then we have sell, and now the question arises, where exactly should be the selling point? So similar tactic can be deployed, and then the next questions arise is that what should be the optimum stop loss and the target price. And I would say that it is going to depend on the volatility of the underlying instrument. So look here, we have got lot of volatility, and still I feel that if we are going for a entry point which is less than the 10%, less by the 10% of the ATR from last candle's closing price, then taking a stop loss of around 30% of the ATR should be good enough. So that way, if we are getting an entry, and then from that level, if the underlying instruments value drop by 40%, that means that our underlying assumptions are not holding well, and it's better if we get out of that trade rather than allowing the account to be depleted. So that can be one way to go about it as well. So let's use that combination, the 10% and 30% of the ATR, 10% for the entry point, and the 30% for the stop loss. There are two ways to go about this. One is we can go for a market open. So for that we can define simply two candles, or we can even go for pending open. Suppose if we are going for the pending open, then that will require different set of combination. We will need to do some calculation and deduct the value, and then bring in the order validity for say 2 hours, 3 hours, or 4 hours, and for that amount of time the order will be valid. So there are both the ways are kind of good, but in today's session we will stick with the market open. So maybe in next time around we can try with the pending open. So let us bring in the further candles. Now we are going to need two historical candles of the 10 seconds. So we go back and look for the info. Here comes the info. Bit side. You can even do this separately, like bid side, ask side for buy and sell. But for the simplicity here, I will simply be working with the bid side only. But that can be also tried. Now let's connect this. We need default estimate, it's good. Here also, this should be 10 seconds. So we got 10 seconds, and comes here also 10 seconds. Okay, this should be shift 1, and then the shift 2, shift 1 and shift 2. So here we got these two candles defined. Now we need to define the 10% and then the 30% of the ATR, and for target price we will use say 75% of the ATR. So our risk reward ratio would be like 2.5. Even after adjusting for the commission and the spread, we will be getting a risk reward ratio of more than 1:2. So let's see, we need to bring in the calculation expressions. Now we need mathematical components. We got the calculation expression. We need to define three values: 10%, 30%, and 75%. So we are going to need three different calculation expression blocks. So now we have got line 22 is our ATR. We get it here. Now we need to create new variable, and it will be ATR10. So we can even take numerical. Oh, 0.1. Okay, we need to create another variable ATR30, and it will be 0.30. We need to create another one ATR75, and it would be 0.75. So we got this. It's okay, it's here. 10%, then the 30%, and then the 75%. Now here we will need to do the type conversion. This is if we take this result as it is going to be in double format, but we want the answer, the solution to be in integer format. For that we will need to do type conversion, which we will do bit later as we bring in the market open. Now we need to do further calculation. Now we got the 10% of the ATR. We will need to deduct this from the candle closing of the last candle with shift 1. So we take this variable as EP, the entry point, and we save it. We will do A1 into A2. So here we connect these blocks. We have now defined the 10% of the ATR. We need to do further calculation. We need to take last candle close value, the candle which closed higher, with some gains after being in a free fall. So we need the candle 17. Here is our candle 17, shift 1. Okay, let's go for its closing price. Candle 17, and we take its closing price and we deduct the execution price. This is for the buy trade, and whenever we will be looking for a sell trade, we will actually need to add back to the candle close, as we would want our algorithm to execute the trade at the optimum level, and that's why we are doing this. So what we are going to do now is candle 17 close A1 minus EP. So it will deduct 10% of the ATR range from the last candle close, A1 minus A2, and this will be our buy entry point, BEP. Okay, and to that we will then need to do the comparison of whether the candle open and the candle close is happening or below that. So we need to add those conditions as well. Let us take some if blocks. We want the logical, at least 2 for the time being, and then again we take it if the need arises. Now the buy candle difference should have been greater than the ATR, that was our basic requirement. Now let us look at certain other requirements as well. But as I see on the watch, we are also kind of running short on time. We are almost approaching our session close, so let us see what we can do before we sign off. And we won't be able to define, I think, the stop loss and the target prices, but still we will take this BP value and then we will compare it to the historical candles of 10 seconds. So we take the candle 35 and candle 36 closing prices and we compare it to the buy entry price. So first the candle 35 and the candle 35, where it is, we got it, okay. We will need here, first one is candle 35. Now here also candle close for the candle 36. And as we are looking for a buy trade, we want the price to be rising. That will mean that just a while back the price was below the buy entry point, which we have defined using the combination of the ATR and the historical candles. So we will need the candle close for the 10 seconds candle with the shift 1 to have been higher, and for the candle 36 close it should have been below. So we again take one more if block, but now we wrap up the session here, and tomorrow we will complete the procedure for building the open at market prices block as well. Candle close should have been less than the buy execution price. So to a very large extent we are done with the buy side. Just a little bit of optimization remains, for which we will be getting back together tomorrow. So let me place this. So now this time to say goodbye and then hello, but that's going to happen only tomorrow. Have an excellent day ahead. See you tomorrow, guys. Thank you for joining in. It was a pleasure working with you. See you tomorrow. Goodbye.